I'm excited to go over some of the provisions of the Tax Cuts and Jobs Act that we are anticipating will be sunsetting at the end of 2025. And I think now is a great opportunity to possibly talk about some things that we can start doing now. So first, let me back up and maybe talk a little bit about what the vision was for the 2017 Tax Cuts and Jobs Act. When this was passed, it was said to be the most sweeping update to the U.S. tax code in more than 30 years. When the bill was released, it was anticipated it would lower taxes on businesses, individuals, and unleash higher wages and more jobs because of all of the tax cuts associated with businesses. Now, on the business front, a lot of the provisions that were passed on the corporate level were permanent, but all of the individual tax provisions were pretty much temporary. So there were a lot of changes, and I remember everyone was all excited on what they could do, restructure, and we were saying, hold your horses, because you don't want to go through all these lengths to change your whole corporate structure to take advantage of some of these provisions, because we knew that they were going to expire. So on that note, let's talk about what some of those provisions were on the income tax side. So there was a whole host of them, and what we wanted to do today is kind of highlight the key ones. So first, starting with the income tax rates and the brackets. So the main thing to note, there's a lot here. You guys can take a picture, and we can also share the slides if you'd like to digest this a little bit more. But the key takeaway here is that before the Tax Cuts and Jobs Act, the top income tax rate was 39.6. And this effectively started at income of $470,000 for married taxpayers. And with the Tax Cuts and Jobs Act, the rate dropped to 37% as the top rate for income of over $731,000. So it's a pretty substantial change. It was almost double and a rate drop. So that's going to be something that once the Tax Cut and Jobs Act sunsets at the end of 2025, basically what's supposed to happen, unless there's a whole other legislation put in place to either make these rates and these changes permanent, everything is supposed to revert back to what it was in 2017. And so that's why we're highlighting what was in place in 2017, so that when the Tax Cuts and Jobs Act sunset, what we're expecting will be in place in 2026 with some inflation adjustments. The other thing you might remember is the standard deduction. This was big buzz around this. The standard deduction was effectively doubled. Single people had a standard deduction of $6,350, while with the Tax Cuts and Jobs Act, that was doubled to $14,600. And look at married people. Their exemption went from $12,700 to $29,200. So this is great for those who didn't have a significant mortgage interest deduction, property taxes, charitable gifts, right? Because it effectively gave them a higher standard deduction. Now, for those folks who were doing charitable gifts and had significant state income taxes and whatnot, they were easily getting over that standard deduction hurdle. So there's some planning to think about, given the fact that in 2026, everything's supposed to revert back. If you remember, there was a perk, a tax benefit to having children. So that was sort of temporarily eliminated with the Tax Cuts and Jobs Act. There was no dependency exemption. So the good news is we should consider having children going forward, because we're going to then be able to take advantage of the dependency exemption. Then one of the big things that had a lot of states up in arms were for folks who lived in New York, California, right, these high income tax states, they went from being able to deduct all their income taxes to having a cap of $10,000, and they were angry. While they were upset, we'll talk about something that really made a lot of these state income taxes not as beneficial as one might think, but the cap will go away, right? If it reverts back to what it was in 2017, there won't be a limit on the $10,000 state income tax deduction. The other thing that had even us a little bit upset was the elimination of miscellaneous itemized deductions. That whole section was removed. So you couldn't deduct your tax preparation fees, your investment advisory fees, and even if you were an employee and you incurred expenses that your company didn't reimburse you, you weren't able to deduct them. So that would effectively come back in 2026. So we'll talk about some ideas there. The charitable cap, it went from being able to deduct 50% of your adjusted gross income in charitable gifts. That went up to 60. And then something that was in the tax code before the Tax Cuts and Jobs Act was this phase out that maybe people didn't pay much attention to, but it was called the P's limitation. So effectively, once your income exceeded 313,000, you were getting pretty much 80% of your itemized deductions just eliminated and wiped out. So right now there's no phase out. So we'll talk about what we can do before that monster comes back in place. But that was really painful for people who had huge charitable gifts. And you often thought, wow, I had a big income year. You know, I sold my business, I sold a property. So this is the year for me to make charitable gifts. And we would say, nope, it's not the year, because now you're going to be subject to the phase out. And if you remember, they cut the corporate tax rate down to 21%. So in order for them to try to equalize the taxes for folks who operated as an S Corp or partnership, they put in place a 20% qualified business income deduction. So that's supposed to go away once the Tax Cuts and Jobs Act sunset. And the last one was AMT was alleviated a little bit, but it was only really alleviated because they had all these eliminations on state income taxes and miscellaneous itemized deductions that were throwing a lot of people into AMT. So that's why the Tax Cuts and Jobs Act didn't really change AMT per se, but because it eliminated a lot of these items that threw people into AMT, there were less people subject to it.